2 weeks ago, I published a video called You're Being Tricked into Buying Bad Stocks. This episode addressed a core question of investing that a lot of people don't understand. Where do returns come from? And throughout the video, we broke down part by part what makes up the total returns of a stock. We went through a company that had a slow 8.7% revenue growth. That revenue growth led to 12.7% earnings growth. The earnings growth created a lot of free cash flow, which allowed the company to do buybacks at 3.7%. The buybacks increased the earnings per share, which added up to 16.4%. Then you add on a 2% dividend yield, you have multiple expansion of 1.5%, and at the end you have a very boring company like Dollar General that's growing at 8.7%, giving you a total return of 20%. Slow growing, boring companies giving outstanding total returns. Now, to a lot of you, this was an eye-opening video, and most of the comments on this video are overwhelmingly positive, more than most of my videos. And I think the reason why this video in particular had such a positive reception is because this type of thing is not only useful, but it's not talked about that much. There's not much content I can see that goes into the specific areas of returns for a stock. So what I'm going to be doing in this video is part 2 of where do returns come from. And in part 2, we're going to be talking about one segment of a stock's returns called buybacks. Buybacks, which are hated by politicians and misunderstood by investors. And even though buybacks play a key role in the total return of your stocks, you probably don't fully understand the mechanics of how this works because most people do not. And I think you'll find this video very insightful. We're going to be going over the hidden power of buybacks. Now, before we jump into stock buybacks, just a quick word for today's sponsor of the video, M1 Finance. I started using M1 Finance literally 5 years ago, back in 2017. I uploaded my first YouTube video in 2019. So I've been using this platform for years, even before ever doing YouTube. The reason that I've been using M1 Finance for so long is because I love their products. M1 Finance offers an ecosystem of tools to manage your wealth. We have M1 Invest here, which I use for my dividend growth portfolio. And M1 Invest is an SEC regulated, US-based member of FINRA and SIPC brokerage. M1 also allows you to use margin, and their margin rate is one of the lowest in the industry. I'm able to borrow over $140,000 based off my passive income portfolio. M1 also has a checking account where I keep my emergency savings. And coming early next year, M1 Finance is offering a high yield savings account with a 4.5% annual percentage yield available to M1 Plus members. And the best part is both the checking account and the saving account are FDIC insured. So if you haven't already, try out M1 Finance right now. They're offering both rewards for new signups and transfers of accounts based on the amount that you're transferring. If you're interested in using M1 Finance, sign up using the link in the description below. Now, like I said, buybacks are one of the most misunderstood things in the stock market that contribute to the total returns of a stock. And I think part of this is because of the reputation buybacks have. Even going back 2 years, when I first started my YouTube channel, I had a very negative perception of buybacks. I actually made a video saying why I hate buybacks, and I talked about all the different problems with them and how buybacks often go hand in hand with financial engineering, stock manipulation, and even greed by the executives of the company. And the way that the news media and especially congressional members treat buybacks is no different.
We've seen from the research that what happens is these big corporations do buybacks and the executives are the ones who profit.
Well, frankly, my bill would end buybacks by getting rid of the rule in the SEC that allows them.
Some congressional members hate buybacks so much that they're literally introducing bills to outright ban them. And if they're not trying to outright ban buybacks, then they're at least trying to rein them in. Buybacks are always treated by congressional members as a problem in the stock market that needs to be solved. And again, early in my investing career, I almost saw it as the same thing. Buybacks are really just this dirty financial engineering problem that needs to be solved. But over the past couple of years, I've become a little bit wiser and I've learned a lot more about the stock market and in particular, these different components of returns. And as such, my views have changed on buybacks. To understand really how buybacks work, I think it's important to understand how a stock gets started in the first place. Stocks get listed as IPOs. That's their initial public offering. When a stock IPOs, that is a privately held company that's now going public, and part of that is selling off shares to the public. They're giving away some of their formerly private shares to the public for a price. And every big publicly traded company went through this at one point or another. We can take Apple as an example here. If we go way back in time to Apple's IPO, it started in 1980. That's when they decided to make the company first public. Now, typically what happens after a company IPOs is the shares will start to go up. And we've seen this same thing with Apple. In the 1990s, the share count started to go up. This is called dilution. It's share issuance. It's when a company prints off more shares to raise more cash. And Apple did this for a long period of time, from the 1990s all the way into the early 2000s. They were constantly giving away more shares to either pay their employees in stock-based compensation or to raise more cash to run the business. Either way, Apple was a dilutive company, like almost any company in its early stages. The share count going up is normal. This is something you almost always see with newer companies. It starts off with the IPO and then it continues on with share issuance. Companies will call this new shares issued or new share issuance. And really what it is them just printing off more shares, creating more shares again to either pay their employees or raise cash for different investments or different expenses. Not only has Apple done this, but Microsoft did the same thing for over 2 decades. They issued more shares to pay for expenses and the share count went up. Google also did the same thing. The same with Meta, and the same thing with Amazon. In fact, Amazon is still doing this. They're constantly issuing more shares, diluting the current shareholders. New share issuance is one of the most common things in the stock market, that it's one of the basic fundamental ways that a company raises cash. They either sell off shares in the company or they take on debt. And one thing that you'll never see is any congressional member upset about dilution. You'll never see them trying to ban share issuance or diluting current shareholders or raising cash through equity. That's never the problem. The problem that they always highlight is not issuing new shares, but it's buying back those shares. And that's where investors get really confused. This is actually more simple than it appears. Companies can not only issue more shares to either raise cash or pay employees, but they can also buy them back. It is literally the opposite thing that they're doing. Instead of creating new shares and diluting the current shareholders, buybacks are just the opposite. The company buybacks the shares back into the treasury of the company, which reduces the amount of shares outstanding. The company's now actually increasing your equity, increasing your stake of ownership in the same company. And a lot of times they're just buying back shares that they previously issued. We can see that that's clearly the case with Apple. And what Congress is basically saying when they suggest that buybacks are evil and they're destructive, they're saying that this part is okay. It's fine. Dilution's okay. Companies can sell shares. That's not a problem. And at the same time, they're saying that this part, where they buy back those same shares that they historically diluted, that's bad. That should be illegal. So companies would be restricted to only doing one thing, only diluting shareholders, but never being able to increase their equity in the company. And this is where we have a fundamental misunderstanding of buybacks. If you're saying that part of this equation is good and okay, but then the other part is bad, it means that stocks can only go one direction with their share count, which doesn't make a lot of sense. And that's where I think we get into the first important point here. Stock buybacks are simply the opposite of dilution. A stock issues shares, and it can do that to raise capital, or it can buy back those shares. And stock buybacks are neither good nor bad. It's simply an investment activity. So buybacks are good or bad on a case-by-case basis, just like any other investment activity. Some investments are good, some investments are bad. And that's how we should view buybacks in our portfolios as well. We all have different investments into stocks, and many of them are doing buybacks. And some companies have used buybacks to tremendous levels of success. One of those companies that's not in my portfolio that has used buybacks to have incredibly good results is Autozone. Autozone pays no dividend. This company has never issued a penny in dividends, and Autozone is growing at a very slow rate, a 6.5% revenue CAGR over the past 10 years. A very slow growing company that in fact has grown a lot slower than the S&P 500. However, year to date, Autozone's up 16%. The past 2 years, it's up 100%. The past 5 years, it's up 240%. And in the past 10 years alone, it's up 569%. And this is where we get into some math. Even though Autozone has grown revenues at a snail's pace of 6.57%, the earnings per share, however, have grown at 17.4% CAGR over the past 10 years. That's about 3 times the speed of the revenue growth. And this disproportionately high earnings per share growth is what's caused the stock to do so well. And that all comes down to the buyback. Autozone is a buyback machine, and you can see that represented in their shares outstanding over time. So if we go back to the 1990s, AutoZone's share count was mostly flat. They were not doing any buybacks. But as soon as we get to the year 2000, it was like they flipped a switch. They started to buy back their shares aggressively. Every quarter, removing more shares outstanding. And you can see the share count correspondingly drop dramatically. This is not an exaggeration. From 1998, Autozone went from 150 million shares to current day having 20 million shares outstanding. That is an 86% reduction in the amount of shares. That's how much of their company they've bought back. 86% of it. With that 86% reduction in shares outstanding, we have 32,000% returns over the past 20 years. Now, if we compare that performance against the S&P 500, even factoring in dividends being reinvested for the S&P 500, this is what the comparison looks like. It's not even close. In fact, it's comically not even close. The S&P 500 over the past 20 years has turned $10,000 into around $50,000, while Autozone would have turned that same $10,000 into $950,000. The results are so far apart that it's almost comical. And Autozone hasn't even accomplished this with multiple expansion. That's not even a component of their total return. Autozone's PE ratio is about the same that it's always been. In fact, right now it's at an 18 PE. This ridiculous performance and these comical percentages of 32,000% gains are the result of buybacks. And this is where the math comes in. Monish Babrai, one of the super investors, shared this chart that shows the simple calculation of how big of an impact buybacks have. For example, if we just start out with the basics and assume that a stock's PE ratio remains flat, so no change in PE ratio, here's some of the calculations you can do to see how big of an impact buybacks will have. If a stock buys back 50% of the shares outstanding, the stock price will go up 100%. You doubled your money on that stock. Another way to look at this is a way for a stock to double without actually increasing earnings at all. All they're really doing is removing the bottom part of that calculation, which is increasing the earnings on a per share basis. Now, the part where this gets complicated is when you go further along with this math. The math is exponential, which is harder for us to comprehend. We know this first number here seems pretty straightforward. If you buy back 50% of the shares outstanding and the company maintains the same PE ratio, the stock price will double. Well, if we bump that up from 50% to 67%, the stock price will go from 2x to 3x. So now you have the company tripling in share price, even though you bought back another 17% of the shares outstanding. If you increase the shares bought back from 67% to 80%, the returns go from a 3x to a 5x. Just another 13% added to that number, and now we have a 5x return, again with no change in the multiple of the stock. Now when we bump that up to 90% of the shares outstanding, we have a 10x return from buybacks alone. And this is how the math checks out for Autozone. Autozone has purchased back almost 90% of their shares outstanding, which means that the stock is a 10x just based on buybacks alone, assuming zero growth in the company. So when we factor in the slow natural growth of the company, in addition to these insane levels of buybacks, that's where you get these crazy, almost incalculable total returns for the stock. The math works exponentially, which is very difficult for us to comprehend. If we bring this calculation even further, just going from 90% of the shares bought back to 95%, doubles the overall return from a 10x to a 20x. And then if a company could theoretically buy back 98% of their shares, it would bump up to a 50x return. If a company bought back 99% of its shares outstanding, the returns with no change in multiple would be 100x. So you can see the exponential levels of growth and returns in relation to the amount of shares being bought back. In fact, some companies like Autozone that participate in buybacks do it in such an intelligent way that it goes underestimated by most investors. For example, Autozone is this company that sells auto parts. Most people are familiar with it. You can either go to Autozone or you can go to O'Reilly. The big problem for these companies are EVs. EVs are here with Tesla and Rivian and all the other companies going into electric vehicles, and therefore you're not going to need poor old Autozone. This company's out of date. And so there's always this looming rainy cloud ahead of the story of Autozone, which investors always try to factor into the share price by bidding the company's multiple down, making Autozone trade at perpetually cheap valuations, always at a low PE, below 24 PE. When they buy back their stock at a cheap price as opposed to an expensive one, those buys go a lot further. That money's more well spent. And since Autozone always has this gloomy story in the future about their inevitable destruction because of EVs, the stock price is always cheap. The always perpetually cheap stock price means that their buybacks are incredibly effective. Since their buybacks are incredibly effective, their share count can be reduced dramatically, around 6 to 7% per year. In fact, in just the past year, they bought back 10% of their shares outstanding. These incredibly effective levels of buybacks from this company are what continue to lead it to this incredible performance, going up 16% this year when the market overall is down. So with Autozone, it's almost like bad news is good news. In fact, the bad news has helped this stock by creating this virtuous cycle. The bad news ahead makes the stock price go down to very low valuations. The low valuations allows Autozone to do buybacks at very attractive levels. Those attractive level of buybacks bumps up the earnings per share to a dramatic extent, and that earnings per share rising has caused the stock price to go up. But Autozone is not the only company that understands the exponential nature of the math behind stock buybacks. Domino's has done the same thing. The company's grown around 10% per year, nothing crazy, but over the past 10 years, they have 722% returns, and a massive component of Domino's returns are their buybacks, reducing the amount of shares outstanding by about 4.5% per year over the past 10 years. There's other companies that are lesser known that are also taking advantage of this incredibly powerful tool of buybacks. Assured Guaranty is one of them. This company's done buybacks at an incredible pace, reducing their shares outstanding from 180 million in 2012 down to 60 million currently. That's around a 70% reduction in shares outstanding over the past decade, and that in and of itself is around a 300% return. And who would have guessed the company's returns over the past decade are around a 300% return? This company has had a 300% return with no growth over the past 10 years. In fact, their revenue's pretty sporadic, some years going up and some years going down. But it doesn't matter. They're reinvesting back into their own company, reducing the shares outstanding, increasing the equity ownership of their shareholders, and as a result, doubling the performance of the S&P 500. And this summarizes the third point here. Low multiple stocks with high levels of buybacks can have amazing returns. And we can see it with all different companies. Primerica is another example. The company's had 364% returns over the past decade, while only having revenue growth of 8.4% because the company's using its perpetual undervaluation of a 10 forward PE to continually buy back its shares at attractive rates. In this case, they've gone from 73 million shares outstanding to 37 million, which in and of itself makes up for over half the total returns of this stock. Another important thing to look at when doing your assessment of a company's buybacks is not how much money they're spending on buybacks, but how effective they are. We can look at Google as a good example of a company that doesn't do effective buybacks. Even though this company spends a fortune on buybacks, the shares outstanding are not going down that quickly. Only 2% over the past 1 year. Well, why are their share buybacks not that effective? Because a company has to do dilution in order to pay their employees. So basically what the company's doing is issuing a lot of shares, and then they're buying back a lot of the shares that they just recently issued. So a lot of the buybacks that they're doing are being offset. They're being neutralized by their stock-based compensation they have to pay to employees. And after factoring that in, the share count doesn't move a whole lot. So even though Google's spending a lot on buybacks, the stock-based compensation really neutralizes the effect. The companies that have the most potent, effective level of buybacks have something in common. First of all, they typically have low valuations, low PE ratios. The second thing is a company should be around for a long period of time with high amounts of free cash flow. This is a must. If a company wants to buy back its shares and really get to those numbers of 50 or 60 or 70% share reduction, the company needs to have a very long runway of durable cash flows that it can continue to shovel back into buybacks. Autozone is an example of this. Since the year 2000, they've had positive free cash flow every single year on a consistent basis. And then third, something these companies need to have that make their buybacks even more effective is very minimal dilution to begin with. In the case of Autozone, the dilution is almost non-existent. They print off just a few shares to pay the executives a couple $1 million, and the amount of free cash flow they generate is orders of magnitude higher than their dilution. This makes it so when the company says they're buying back their actual shares, they're not just neutralizing ones they previously issued, but they're actually reducing the share count. That is the ultimate goal here, to reduce the amount of shares outstanding. And so while Google's reducing their shares outstanding by 2%, Autozone is reducing their shares outstanding by 10%. Low valuation, a stable business with consistent free cash flow, and low levels of stock-based compensation or dilution results in an incredibly effective buyback program. So when we're looking for those three things, some companies come to mind. Two of which I've been buying into recently, which are railroads. We can take Union Pacific, for example. Union Pacific trades at a pretty low valuation. The price to earnings multiple is a 17.9. Like almost every Class 1 railroad, they have very consistent high levels of free cash flow. The free cash flows have grown over time, but that is not a must. That's not something that has to happen. The free cash flows really just have to be consistent, but growth in free cash flow is only a plus. Union Pacific does almost no dilution, there's no stock-based compensation, and that means that this free cash flow can be directed towards buybacks. Union Pacific directs a lot of their money in dividends, but even their money that they direct towards buybacks is highly effective, reducing the share count from over 1 billion back in 2006 to currently being 650 million. So they've reduced it around 45%, which in and of itself creates about a double for this stock. So since 2005, this company has doubled the share price just from buybacks alone. Union Pacific is a great buyback candidate. It's a company that perpetually trades at a low valuation. It's a company that has an incredibly long, durable runway of free cash flows, and a company that can continue to reinvest almost all of its money into buybacks because it pays very little to almost nothing in dilution or stock-based compensation. And that's something to factor in addition to the dividends this company pays. So when you're looking through your investments, take a look at what direction the shares outstanding are going, because the math works both ways. And while there's some companies like Autozone that have reduced the shares outstanding, there's other ones like Snapchat that are going in the opposite direction. As they issue more and more shares, the math works in the exact opposite direction. Double the shares outstanding means that if the company's multiple stays the same, the stock price will drop in half. And that's what we're seeing happen with a lot of these companies. They continue to issue more and more shares, making it more difficult for shareholders to have good returns. So all in all, when I look at my companies, I think buybacks get a little bit of a bad rap. I don't think they're such a bad thing. And I think if they're done in the right way, they can be an incredibly powerful force in the total returns of your stocks. Hope you enjoyed the episode. That's all for now. I'll see you in the next one.